Hi, everyone. Welcome to the San Francisco Foundation's annual Investment and Impact Briefing. I'm Sonia Velez. I'm the Chief Financial Officer here at the Foundation. We hold this event every year to update our donors and our community on the last year and how we're managing and investing the generous gifts that have been entrusted to us over time. We have about 100 participants registered and joining us. I know you're all still coming in today, so that includes donors, fund holders, nonprofit agency fund partners, many of the professional advisors we work with, as well as foundation board members and volunteers. As a community foundation, we are most successful when we work in collaboration with all of you, and we appreciate the value that you place on creating positive social change through your giving, and we're grateful to you that so many of you support our work and for the many ways you help to ensure that we live in a vibrant Bay Area where everyone has a chance to thrive. So for this year's theme, we're going to be talking about investing with purpose amid the headlines. And every day, the news is offering us dramatic stories about policy changes, administrative actions, economic conditions, and the geopolitical landscape. And for many of us in the nonprofit sector, and for the people they and we serve, there's tremendous uncertainty and overwhelm right now. But amid the headlines and current events, the San Francisco Foundation remains dedicated to being a steadfast resource for philanthropy, and we remain committed to advancing equity and economic inclusion in the region through our programs, our civic leadership, our grant making, and our advocacy and policy work. And of course, we're closely tracking the federal and state policy changes and their potential impact on our grantees, our donors, and the communities that we serve. And we'll continue to engage donor-advised fund holders and others on the ways that we can pool resources, share ideas and information, and support local efforts. And then finally, as a community foundation, we're meant to serve the region in perpetuity. We see ourselves as part of the civic infrastructure of the Bay Area. And this means that we have an obligation to strike a balance between the pressing needs of today and ensure that we will be here to support the generations that come after us. And we'll remain focused on the long-term goal of generating strong investment results to maximize the resources available to serve our community. So to bring you up to date, currently the San Francisco Foundation has about 1.7 billion in assets, and that includes a bit over 900 million in endowment funds, about 600 million in donor advised funds, roughly 70 million in nonprofit agency funds, and then the rest for other purposes. So in 2024, we distributed over 200 million in grants to almost 3,150 nonprofit organizations here in the Bay Area and beyond. So for today's agenda, we're going to be hearing from Mike Miller, our Chief Investment Officer for Crucial Partners, an independent investment advisory firm focused on nonprofit institutions. And Mike and Crucial, along with our fantastic investment committee, have expertly guided the San Francisco Foundation for more than 2 decades. Mike is going to be presenting the big picture along with his insights about how we're investing with purpose during this current climate amid the headlines. And then we'll turn to Mark Doherty, our San Francisco Foundation's Senior Director of Investments, and he's going to talk specifically about our investment pools and the options that we have for our donors. And that'll be followed by Q&A. We're hoping for 15 to 20 minutes to answer any questions that you may have. And at that time, Mike, Mark, and I will be joined by 2 of our investment committee members, Justina Lai and David Ibnali. So for the Q&A, please submit your questions for any of us using the Q&A feature, and you can send them in at any time during the webinar. And we're allotting a little more time this year, hoping that we can get to as many of them as we can at the end. So with that, I'm going to turn us over to Mike Miller from Crucial.
Good. Thank you, Sonia, and good afternoon, everyone. Really nice to be here with you today. I'm going to bring up some slides. Hopefully this will be effective technically. In 1 second, I just want to figure out how to, sorry, here we go. Make that a little bigger. One more time. There we go. So as Sonia mentioned, the San Francisco Foundation offers a variety of different pools that fund holders can choose. And here we've basically put the four major ones here on this pie chart. So there's the endowment pool that Sonia referred to. There's a longer term donor advised pool, which is the 313 million you see here. There's a short term pool of 322 million, and there's a mission aligned investment pool of 122 million. So these pools all have different objectives, different purposes. And as you might guess, the long term, the endowment, and the mission aligned pool, so all very long term oriented, whereas the short term pool is not, and it's for more immediate funding needs and working and philanthropy, excuse me, in your community. So we turn to this slide. We'll start with a quick performance review through the end of last year. Returns remain very, very strong, particularly over the longer periods of time. The orange bars are the mission aligned pool, and you can see it actually lagged last year. A lot of that did actually happen around in the run up to and post the election, where there are holdings we have and essentially things related to climate change and sustainable energy, for example, that have actually struggled in the election era, as you might guess. We actually think a lot of that is an overreaction by the markets, which is what they tend to do. The blue bars are the long-term donor advised portfolio. We call it the core portfolio as well here. And the red bars are a simple 60-40 blend of stocks and bonds meant to answer the question, what if we had just put our money into simple index funds, which is a fairly common strategy today. And then the green bars are what the average endowment and foundation did. And you can see over time, for the most part, the blue bars are well ahead of any of these measures, essentially the blue bar being, again, the San Francisco Foundation's long-term donor advised pool. The orange bar has kind of lagged over the last 5 years a bit, but it's actually ahead of the benchmark, at least the 60-40 benchmark. And we expect it will once again be closer to the long-term donor advised pool as it has been in the past, by the way. So these returns have actually been, they continue to be quite strong. I will emphasize quite a few things today. One of them is the risk that we see in the markets, and it's a particularly difficult issue to consider as you think about the world and how complicated it's been and how chaotic it has certainly become, especially in the last few months. And so this is really important that we have a strategy that has durability and has purpose, and can succeed in a variety of climates. But the key thing that I'm going to hopefully leave you with today is that we spend a lot of time thinking about what's happening in the world, trying to understand how it affects our portfolio and how we protect the portfolio, and also capitalize on opportunities when they do exist, because they do tend to exist when things get more complicated in the world. That's one of the few, I suppose, silver linings to a chaotic market climate, is that it creates opportunities for long-term investors. And the key is, again, is these long-term outcomes, because as Sonia so properly and correctly said, we have a lot of immediate need for capital in this community. We also have need that will exist 5 and 10 and 15 and 20 years from now, and we need to be in a position where the portfolios at that time can succeed as well and can support philanthropy in the Bay Area. And these long-term charts really show how successful we've been. But if you turn for a second, one of the things that we think about a lot, though, is the compounding of capital. So everything I showed you on the slide before represent per year returns for each of the pools. Here, what we've done is we've simply taken the long-term pool and the 60-40 benchmark, just to put those just side by side quickly, and shown what compounding does. And just I'll go back and forth for just a second. If you go back and look at this slide, obviously you can see, if you look at things like 10 years, 15 years, and 20 years, the superior returns of the foundation. Yet you could also say, wow, the 15-year number at 8% or so per year looks a lot more impressive than the 20-year number. But then you look at this, and here's what that compounds out to. And so you'll see, massive premiums to these benchmarks. And that's one of the reasons that we've had success here, and we've been able to capitalize on a variety of complicated times. But again, everything is about how do you support philanthropy today, and how do you keep things without making sacrifices for the future? And that's what a lot of my remarks today will be very much centered on. These are the two mixes, the strategic asset mixes of the two pools. The long-term pool, you can see, has 48% in hedge funds, 48% in global equity, 15% in hedge funds, 12% in private assets, and 25% in fixed income. The mission aligned pool has 60% in stocks. It does not own hedge funds, but it has a similar level of private asset exposure and a little bit more in fixed income. Key of both of these pools and their strategic mixes is they are designed to generate the outcomes I showed you before, which is to fairly superior long-term returns. And a lot of this is about balance and diversification. And also we think about whether or not stocks will pay us an appropriate premium to bonds. And you can make an argument that that's getting a little harder to justify today, particularly if you own something like the S&P 500. But the emphasis is on long-term returning asset classes. Diversification, which I'll touch on several times today, is very important. And that last line is a little controversial for some, but not for us. We don't love volatility because it usually happens when the world is getting complicated, when bad things are happening. So we're not wishing for it to happen, but it does happen, and we have to live with its implications. And we actually don't really fear it, to be clear. Volatility, as I mentioned earlier, creates opportunities for long-term investors. So the climate today, and some of this, by the way, precedes what happened in the United States in November in our election. And that's what makes this time particularly challenging, which is that we have an administration right now which is acting in an incredibly bizarre way, I guess is the only way to describe it. And they're doing so at the same time they have all these other geopolitical and macro forces that were already here. And so now you've just made it essentially more complicated, more difficult, more challenging. And it's really, really a complex time. And here we've outlined three of the issues that we're really worried about the most. The first is inflation being higher. Back in 2022, when inflation spiked, almost every reasonable person, including us, didn't think that would last, and it didn't, of course. But we're still left with inflation that is higher than what people become accustomed to over the last 15 years. And our view is it will stay higher. And especially if you look at, again, some of the forces exist in the world prior to the election. And then since the election, some of these inflationary forces have even gotten stronger and stronger. So it's very complicated. And what higher inflation does, it has incredibly important implications for capital markets. The biggest one being that interest rates should be higher, as they already have started to become. And higher interest rates put more pressure on companies, put more pressure on consumers. They create a much more risky climate. And inflation is the core of all this. And the second thing that's related to that is things like central banks like the Federal Reserve, which had gotten into the habit for many years of just really pumping tons and tons of money into the markets, into the system every time there was a hiccup. They have less flexibility today to do so because they can't just start creating lots of new capital, new money when there's already an inflation problem. It was easy to do that when there was no inflation, but today we have inflation and they're well aware of this, and it creates a lot more pressure. That leads to the second box, which is capital scarcity. I mentioned earlier that maybe bonds are pretty good competition for the S&P 500 on a go-forward basis. That's one of the sources of capital scarcity, which is that as you have more and more choices as an investor, including some that feel very safe, maybe you'll go there. And when the point of quantitative easing and central banks printing lots of money and creating lots of money over the years was to drive people into riskier and riskier positions, which they were successful at doing, actually. But the concept now is that we go in the other way, then risk becomes something that it can be much, much more dangerous for an investor, and you can't quite get bailed out by quote unquote a lot of easy money. And then last but not least is the obvious one, which is the geopolitical climate. I mean, I'm not even sure the word unpredictable is the right word here. It's pure chaos, and it's a huge challenge for every investor. And I will say one thing. I'm going to keep going back to this as well. Is the answer to chaos and the answer to complexity isn't concentration. The answer is diversification. That's how you get through complicated times. And so what's happening is right now is that we have an index which has essentially become more and more concentrated in the so-called Magnificent Seven, these top names in the index. And these names are, they're names like Alphabet and Amazon and Microsoft and Tesla, and Nvidia, et cetera, and go down the line of names. And there's a lot of troubling issues here with just the simple fact that more and more of the index is in these 10 names, these 7 to 10 names. And when that happens, the problem with that is that concentration and risk are synonyms as an investor. If you put all your money in one thing and that one thing does great, then you're happy. But if that one thing does very badly, you're extremely unhappy, particularly if what badly means isn't just going down for a few months, but literally permanently loses money. And so risk and concentration are synonyms. If you had less in everything, then you wouldn't have the same level of risk in theory. And the challenge that we feel very strongly about today is that a lot of these top names in the US that everyone's kind of raced into have a lot of common risk factors. And so I actually think I didn't create this as a super cool chart in the concept of an iceberg and all the things that exist under the surface that people are really could and should be able to see, but are choosing to ignore for the most part. And I just kind of run through these quickly. One being monopolies. Most of the largest businesses in the United States today by size as portfolio companies go are monopolies. And monopolies might feel good for a little while, but ultimately they are subject to consumer backlash, government backlash. Monopolies don't generally survive forever simply because it's really they tend to distort a whole bunch of things in our economy and make it harder for consumers ultimately. Underneath that, dependence on China. If I've sat in a room with a lot of investors and I asked them, how much of your portfolio would you like to put in Chinese listed companies? A lot of people in the United States today would say zero. I'm not saying that's the right answer, but that's what people would say. Yet they blithely ignore the fact that companies like Apple, Tesla, et cetera, NVIDIA have a lot of dependence on China as both a trading, someone to sell products to, places to make and manufacture products, and the dependence is extremely high. And it just fascinates me that nobody wants to invest in a country, yet they're perfectly happy to have a huge part of their portfolio exposed to the exact same risks they're worried about. Moving around to the other side here, AI hype. So let me be clear. Artificial intelligence is a real thing. It has significant implications. We use it at Crucial a lot already. It's really cool stuff. A lot of it is a lot more to come. No one's arguing that point. But by hype, we're referring to people who are trying to find simple answers and thinking, well, we know that this company is going to be the winner in the AI future world we have. And frankly, you can really debunk that really quickly by reminding people of what last time we had a scenario like this, which was in the late 90s, and everybody was very sure that Cisco would be the company that would rule the world because they were going to be providing network hardware for the internet. And the internet was going to be a very big deal, and it is. It is a big deal, but Cisco has not been nearly as successful as people thought. And the stock has been extremely tough for a very long period of time. So that by hype, that's what I mean, is oversimplification, not denial of what artificial intelligence is and how important it will be. And last but not least, the reason people are ignoring these things is because they're just brimming with optimism. And the reason people are brimming with optimism is simple. These stocks have done really, really well for a very long time in many cases. And therefore, there's a behavioral flaw we all suffer from called recency bias, where whatever's happening right now, we kind of feel like it will continue. And that's a dangerous thing to think about as an investor or to behave in that manner because things do change and there are cycles that have to be considered. So the other thing I want to spend just a minute on here quickly is this chart, because Sonia referred to impact several times, and I've referred to it several times. And impact is actually has nothing to do, or very little to do, I should say, with the charts I showed you earlier about the strong performance of the foundation. That was the foundation's returns, which have been strong and impactful compared to benchmarks. But the reality is that beating benchmarks isn't good enough. You have to beat benchmarks and you have to generate positive, meaningful rates of return. So just hypothetically, in a world where the S&P 500 does, let's say, 3% a year for the next 5 years, and let's say the San Francisco Foundation has success and earns 4, that's not success. We need to earn 8. And so we have to do things to make sure that we lower the odds of, of not earning our 8. And tracking benchmarks at dangerous times like we're in today is one way to increase your odds of not earning 8. So this chart is meant to kind of frighten you a little bit, forgive me for that, but it's also meant to debunk some myths that exist. So this is a kind of a complicated chart, but let me explain it. This line is showing you how what we call value stocks are doing compared to growth stocks. And just to define that for a minute, value stocks tend to be cheaper companies the market doesn't like as much for whatever reason. They might be banks, they might be cyclical businesses, there might be reasons the market doesn't like them, but whatever they are, they're valued because they're cheap, and i.e. they're out of favor. People are pessimistic about them. Growth stocks, on the other hand, tend to be, as the name suggests, companies that are growing more quickly than the market or more quickly than the economy. They tend to be companies that may or may not be cheap. They're usually not cheap if they're in a growth index, and they're more popular. They're much more accepted. They're all the good things that people love about investing. And as you will not be surprised to hear, a lot of the growth stocks in the indices today are technology companies, of course, or these very large consumer companies like Amazon, for example. So that's what this chart looks like. Now, again, if you walk into a room and you ask people, would you rather own cheap businesses or growing businesses? Especially today, I feel like almost everybody, except for me, like say, I want to own growing businesses. And that's true because it feels good to own things that are growing. But the challenge is that investing is always two-dimensional. It's not whether something's growing or not, it's what you're paying for that growth or paying or not paying for that growth in the case of value stocks. So let's debunk these myths, and let's also talk about why growth investing has some significant problems that we worry about a lot. So starting in the middle, you see that big red circle right in the middle of the page. What that is showing you is what the long-term returns of growth stocks have been versus value stocks, which, by the way, is interesting. They're about the same. So the idea that growth stock investing is superior to value investing is actually categorically false. And this is particularly true because when you look at the line, which I didn't spend much time on, you can see that white section on the far right-hand side. Actually, it's almost the whole third of the graph to the right. When that line is dropping the way it is, that means growth stocks are outperforming value stocks. So we have been in an incredible cycle for growth stocks. And even after what's been nearly 18 years of uninterrupted performance, 2022 being the one exception, growth stocks are still barely beating value stocks in the middle of the page. So that should also help you with thinking about, well, is that a growth stocks really superior? But it gets worse for growth stocks. So let's look at the two circles on the right side of the page. The one at the top is basically showing you what is the performance of growth stocks, again, the ones where the companies are growing quicker versus the cheap value stocks during times in the upper right where growth stocks are outperforming. So value stocks actually do pretty well. Remember I mentioned 8% before? Value indices have returned about 14.8% per year during times when growth stocks are doing well. Normally, we'd be thrilled to death with 14.9. I would take that every day of the week. If we could get that, that would be amazing. We'd have no problems at all. But people don't tend to be happy with that return because, and justifiably so, they're like, yeah, but I could have had 29.4 if I'd invested in growth stocks, which is exactly the climate we're in right now, where people look at value indices, value stocks, and they've had actually pretty good absolute returns, but not nearly as good as growth stocks for quite some time. Now look at the bottom circle, and this is really the key point. In the times where value stocks do well, they have generated actually a slightly lower return than when growth stocks are doing well, but still 13.8% per year. And look at the growth stocks, 0.6% per year. And if you go back to my 8, for example, if we're in a start of a period or in a period where growth stocks do 1% a year, 2% a year, 0 per year, like they've done historically when they're not in favor, that is a philanthropic disaster, especially if it lasts 5 years, 7 years, and this next one could, because the interesting thing about investing is the cycles have a certain kind of a gravitational force to them. The stronger a cycle is in one direction, it usually is just as strong in the other direction. And so we're kind of set up for a very difficult time here for some of these growth stocks. And the reality is that if that does come to pass, the absolute return bar will not be hit, and it'll be a miserable failure. And that's, again, something that we think about a lot. We cannot let this happen, which gets us to the conclusion here of what we're trying to talk about, what we're trying to think about when we think about investing today. And again, I want to leave you with this thought. You didn't need me to tell you that this is a complicated time, but I think it's actually even more complicated as an investor than you might think. For us, it's an incredible intellectual challenge, and we're tapping into experience. We're tapping into the people that we know around the world who have a lot of different opinions about how you invest capital wisely, and we're also tapping into just trying to understand how best to, again, protect the assets you have. And protect doesn't mean not have volatility. It means grow them by this 8% per year. So we're sticking with some old rules and adding some new ones. So old rule number 1, you have to stay long term. It's particularly important when markets get volatile and when the world gets volatile. You can't give up on that. The second thing, which has also been a curiosity over the years for us, is we never try to predict short-term results. So 2 years ago, we weren't predicting a recession, not because we thought or didn't think there would be a recession. We just think we don't know. So we don't do that. And I find it fascinating that during complex times, people feel this pressure to have even more of an opinion about what will happen next. And so that's why we wrote this bullet point. Significant of near-term events doesn't make it easier to forecast. Arguably, it makes it even harder to forecast what's going to happen next, particularly with this administration. This third point, I think, is something that people are not paying attention to, and they really should be. You should be afraid of things that everybody agrees on. There's an old expression I still love from investing, which is risk is greatest when agreement is greatest. And the agreement around these Magnificent 7 or 6, whatever names you want to include in that list today, is way too widespread. Everybody owns them. Everyone thinks they're great. That's the definition of a crowded trade. And that should make you very, very nervous if you own these names. The thing that nobody wants to do is the fourth bullet point, which is to own less popular, unpopular things. We do a lot of that, the portfolio, and that is a wonderful way to invest. And it's a wonderful way to invest for 2 reasons. The first being human nature. So just in the way that people get too optimistic about things and like growth stocks today and make them so expensive that they turn into bad investments, even if they're great companies, they do the exact opposite on more difficult companies. They pound them into the ground. They're so cheap that they become good investments, even if they're just barely mediocre companies. That's an incredibly important concept in investing that very few people want to take on, essentially. And we wrote those words margin of safety for a reason here. Margin of safety is an old concept in investing, which basically says, I don't want to pay for great outcomes. I want to pay for maybe even poor outcomes if I can get away with it with a good business, because if that happens and things aren't so good, if I didn't pay for great, I don't have to get punished as an investor. And the problem right now is people, especially in these top names, are essentially paying for really optimistic outcomes. And we're just simply saying, what if? What if things aren't so great? And I don't need to list for all of you. I think we all have our own list of like 1,000 things right now that could go wrong in the world right now. And the reality is that if any of those things become important enough and happen, the stuff that when you paid for a great outcome, you're in trouble. If you paid for an or worse outcome, you actually will be fine. And it lets you rely on that long-term exposure, long-term perspective, excuse me. And then last but not least is we seek protection and diversification. We're seeing it play out very much as we speak right now, where you see assets starting to flow back into places like Europe and Japan, actually even flowing a little bit into China right now. You see currencies changing their valuations quite a bit. And the foundation is actually right now in a period of significantly outperforming things like US indices because it has all this diversification. Those things held us back last year, for example, a little bit. But again, we're not interested. If we're going to make 10% and be held back a little bit, we're very happy with that. What we're not willing to do is have negative returns for the next 5 years because the world's adjusting to all the events that are occurring around us, and the markets will eventually adjust to those things. So again, it's a very complicated time, and the key is stay long term. Don't let the volatility get to you too much, but also be very, very afraid of things that have done really well and are really popular. Those are the things that can hurt you the most as we go forward. I'm going to stop sharing and hand this over to Mark right now.
Great. Thanks, Mike. And hi, everybody. I am Mark Doherty. I'm the Senior Director of Investments here at the San Francisco Foundation, and it's great to be with you all. Before I get started, I just wanted to kick off by saying thank you to the folks who are behind the scenes and have been working on getting this forum prepared and organized for all of you. So I really want to put a huge shout out of gratitude to Angela, Tui, Pamela, Tara, and Jayana for all the incredible work that you've been doing. We would literally be lost without you. So I'm going to cover three things today for you. The first is around our governance and investment approach, and I'm going to remind you of the investment options that are available at the foundation, which Mike talked about at the top of his presentation. I'm going to tell you about how we invest to align with our mission, and then I'm going to leave you with a couple of examples of investments that we made in 2024, specifically centered around affordable housing solutions in the Bay Area. So we're today talking about how the foundation purposely invests amidst the headlines. So here are some from the Federal Reserve in 2022 to help frame up our country's racial wealth gap, which is one of the systemic challenges that we strive to address via our investments. So $240,000, that's the gap in median wealth between white families and Black families, $240,000. $220,000, that's the gap between white families and Latino families. And these are the largest gaps since the Fed began tracking this data in 1983. The smallest gaps were back in the 90s when in 92, the gap was $124,000 for Black families. And in 95, it was $125,000 for Latino families. So in the span of around 30 years, the racial wealth gap in the United States has effectively been doubled. So why is this happening? One word that I would suggest that you consider is equity. Equity in the context of this, though, means multiple things. Some more stats for you. 39% of Black families own stock in the stock market versus 65% of white families. Private business ownership in the United States, 3% held by Black families, 85% of that is held by white families. And home ownership, 44% of Black families own their home versus 73% of white families. So to quote Manuel Pastor, he's the head of the University of Southern California's Equity Research Institute, these gaps exist because people have been kept, not left behind, through barriers to stock market participation, home ownership, and wealth inheritance. Now, I have a few more headlines for you. $8.5 trillion. That's the amount of money that's estimated to be needed to that racial wealth gap that I described, according to Bridgespan. Now, that's by which the top 1% saw their wealth increase in just the past 4 years. 8.5 trillion, 11 trillion for just 1.2 million families. It's also Women's History Month right now. We have a widening gender pay gap where women right now are earning around 83 cents per the male dollar. There isn't much progress on this, unfortunately, because at the turn of the century, it was around 80 cents to the dollar of male earning power. Now, keep in mind, prior to 1974, of course, women could work in the economy in the United States, but they couldn't get a loan, a credit card, they couldn't get a mortgage without having a male co-signature. Despite all of those factors, women presently have around a third of the wealth in the United States, and they drive 25% of our US GDP. So the lesson I'm trying to make is that our economy adjusts to more participants. As women entered the workforce, it grew and expanded. Our economy is not about a zero sum. Contrary to the headlines that we've been hearing about of late, it's actually more beneficial for the United States to have its economy be more inclusive and equitable. So I'm going to start sharing some slides, so bear with me while I deal with that. Okay. So I want to start by grounding everyone in how we oversee our investments. What you see before you are our investment committee members. And Molly, Justina, and David are all members of our board of trustees. The balance of the committee are investment professionals from the Bay Area who volunteer their time and their investment acumen to help oversee the assets of the foundation, as Sonia described. Justina and David are going to join us a little bit later for a Q&A. Crucial, who you heard from a moment ago with Mike Miller, they've been our investment consultant partner for the past couple of decades, and their job is to go around the world and find the top tier investment managers that we're going to be investing into, bringing those to our investment committee, and then tracking performance and keeping in contact with all the managers. My team is able to oversee then the administration of all the investments we have within the various portfolios, and that includes north of about 100 different funds right now. And I want to really shout out now gratitude towards Jeannie and Michelle for all the work that you do for the foundation and keeping all the trains running on time. We would be lost in very difficult times without the two of you. Now, in previous decades, investments and foundations had two different spheres when it came to thinking about their money. Breaking this Venn diagram apart, there's financial returns and social returns. In the old days, it used to be that nations would try and generate as much money as they could in financial returns and then give it away via grants for social returns. And this is sort of the 95% in financial, 5% in social returns. Making money, giving away. Now, as this Venn diagram shows, we've been trying to actively increase the overlay of our foundation's investments over time. And when we allocate our foundation's capital, there's a spectrum of impact and returns that we consider, from traditional, where you're really focused upon generating financial returns and you're not focused upon the impact, social impact results. And then you move along that spectrum and use managers that are using sustainable and responsible strategies, or they're impact investors. Now, when you open a fund at the foundation, you have a few options when you allocate the capital in that fund. You can put that into the long-term pool or in an endowed fund. You can put it in the short-term pool or the mission-aligned investments pool. Now, Mike had mentioned earlier that we call the long-term pool and the endowment our core portfolio. We group that together because they use the same managers. It's just the asset allocation weightings are a little bit different within the portfolios. We have at the foundation two different approaches on impact investing. Our mission-aligned investments pool, which is seeking to generate market rate returns from our stock, bond, and venture capital managers. And then we have our Bay Area Community Impact Fund, which is our strongest impact investment strategy that we offer. What this seeks to do is it tries to be a sustainable fund, keeping a pace with inflation, and makes concessionary loans to nonprofit organizations in the Bay Area that are advancing our mission. And I'm going to talk about both of those in more detail in a couple of slides. So I want to share out how we advance our mission through investments. And if you've been around the foundation at all, you know that it's really a key focus of ours about advancing racial equity in communities. That includes the investment community, where presently around 95% of assets are overseen by white male-led firms. And we all know the diversification mix of your portfolio from an asset class perspective is the primary driver of returns. I would also suggest that you, especially as an institutional investor, think about the mix of your investment managers to help as another driver of returns. Now, I want to pause and take a moment and discuss three of the most politicized letters probably of 2025 to date, and those are DE and I. Now, to quote Professor Pastor again, this is about work, not woke. We aren't doing this at the foundation to be woke. Rather, amidst the headlines and the executive orders canceling out DEI, we hold a fiduciary duty to seek top-tier returns, and we do so by bringing white men, women, and people of color to the table as our investment managers. We aren't limited, and we are not interested in limiting ourselves in our investment opportunities. And we are entrusted with $1.7 billion, as Sonia said, and we don't want to have that defaulted into the standard investment community of just a white male informational bubble. So we're going to continue to work towards this, and we're going to continue to find top-tier managers providing us with outsized returns. So as you can see on this slide, 37% of our assets are allocated with firms that are majority owned by women and people of color. Contrast that with the investment community standard of around 5% diverse. On the right side, you see the growth of the number of funds that we've been allocating to diverse managers over the past years, and we're pleased with the growth that we've been able to make and the progress to date. The next thing I want to share with you is this progress in a broader context of mission alignment. On the left-hand side, you see in 2017 how the portfolio was constructed from an mission alignment. So break this down into three pieces. On the left-hand side in 2017, we had a small portion of our assets that were in our Bay Area Community Impact Fund. That's BASIF, that acronym there. And that had around $8 million, and that was making those loans into nonprofit organizations. We also had, for our mission-related investment strategy, trying to generate market rate returns, we had a socially responsible mutual fund, which had around $70 million of donor-advised funds. And then there was the balance, which was allocated into the long-term pool, the short-term pool, and our endowment, and that rolled up to around $1.3 billion. Now, fast forward to 2024, and you see on the right-hand side where things stood at the end of last year. And we're delighted to say that right now we have around 49% of our assets allocated in alignment with our mission. So to break these numbers down for you, starting again with our concessionary loan program, it's significantly increased over the past several years. As you can see, we have over $100 million of committed loan facilities to organizations in the Bay Area. The Bay Area Community Impact Fund has grown from $8 million to now $36 million. If your fund happens to be allocated into the long-term pool, the mission-aligned investments pool, you actually have an allocation into this portfolio because we've put a portion of that capital into work in the community via this strategy. We also have what we call bespoke loans. And this collectively is around $67 million of committed facilities where we've made loans on behalf of donor-advised funds, specifically out to singular organizations. So we have two ways that we're doing concessionary loans. One is a pooled fund, and the second strategy is where we're doing it directly on behalf of donor-advised funds. And a huge thank you to Sarah Taylor and Jess Montesinos, who are on point for this program. They've been doing fantastic work in driving the impact that we have in the community. Now, on the market rate side, we have now, as you can see, $807 million grouped into that. And to break that apart into three pies, we have around $122 million in the mission-aligned investments pool. We also have managers in our short-term pool, the long-term pool, and the endowment, which use the same social screens as in our mission-aligned pool. That accounts for a little bit over $500 million, $550 million. The balance of that $807 million is money that we have allocated to diverse managers that are in our long-term pool or in the endowment And we've backed them to do a couple of things. One, of course, to generate top-tier returns, but we're also trying to change the face of the investment management community, as I mentioned, by empowering these individuals and these investors with capital, and in many cases, helping them expand as a business and as portfolio managers. Now, I want to reassure you that the lower portion of that chart, $841 million, is not in any way invested against the mission of the foundation. It's just simply that these are managers in our long-term pool and in our endowment that are focused upon generating top-tier outsized returns relative to the marketplace, and they aren't investing in ways that are damaging our community. And so for some context, at the end of 2024, we had around 5% of our assets exposed in that portfolio in the long term in the endowment into fossil fuels. We don't have any allocations into private prisons or predatory lenders. Of course, we're proud of the progress that we've made to date. I personally am delighted that we've gotten to 50% now, but we're not done. So the question is, now what's next? So I would say that we're going to have three things on our radar. One is sharpening how our investments are going to continue to advance our equity work. Mike Miller at Crucial and I are going to continue to be closely engaged with our managers. And then third is that the foundation is going to be delivered around climate. Now, on this last point, I'm delighted to announce that at its last meeting, our board approved a commitment by the foundation to create an investment portfolio with a net zero carbon footprint by 2040. Now, we recognize a couple of things about this. One, as asset allocators, we're a couple of degrees away from actually reducing carbon in the climate. We allocate capital to managers who then invest into companies who are emitting carbon out into the environment. So we understand there's 3 degrees away of separation and influence, but we really are going to be focused upon this going forward. We also recognize the headlines that the United States has stepped away from the Paris Accord, and the current administration has their views around climate change. But it's our opinion that when this administration is barely visible in the rear view, the world is going to be working in a low carbon future. And we would expect and want our managers to be investing towards that future today. So I'm going to wrap up now with a couple of examples about how the foundation has been investing to advance our mission through a couple of deals that we did last year. And the first one I'm going to tell you about is through our mission-aligned investments pool, and then the second is through our Bay Area Community Impact Fund. So these are both strategies that we deployed through our impact investments. And one is, again, focused on trying to generate market rate returns, while the second is around having concessionary rate returns, which are less than what we would otherwise be able to get. Now, housing is obviously a huge challenge here in the Bay Area. And if you've ever heard our CEO, Fred Blackwell, speak, he will tell you that the foundation is all in on housing. And by that, he means we use our grants, our policy work, our investments to try and tackle problems. So in this case, as you can see, Vistria is a company that we invested into through the Mission-Aligned Investments Pool. It was a national company in the United States. It was founded by a Black entrepreneur. And what they do is they go out into properties and they purchase them, and they do conversions and rent improvements on the properties. And so the property and project that I'm highlighting for you here is actually in San Mateo, nearby San Francisco, where they purchased a 700-unit property, multifamily apartment building, and now they're converting it from market rate to becoming more affordable, with the idea being that the residents are going to become families that earn around 80% of the area median income. The other piece that I wanted to highlight here is that residents are going to be using, and Vistria partners with a firm called Isuzu. They do this across all their investments across the country. And what Isuzu does is they partner with property managers so that you, as a tenant, pay your rent on time to the property manager. The property manager then reports that to credit agencies, helping you improve your credit score. That's something that didn't exist previously, and that was reserved just for those of us who hold a mortgage. So the nice thing about this for me as an investor is that that company, Isuzu, is actually a portfolio company in one of our other investments in the Mission-Aligned pool through one of our venture capital firms. So it's really hitting from multiple sides. Last year, we made several investments through our PRI funds, our program-related investment strategy, into and around housing. The one that I want to spotlight for you here is called EPA Can Do, or East Palo Alto Community Alliance. In this situation, what we've done is we gave them $1 million loan, as you can see, for 4%, and they're going to repay it back in 10 years. EPA Can Do has taken that money, and they're going to be going out into the market in East Palo Alto and purchasing 10 single-family homes where the residents are at risk of displacement. Once EPA Can Do owns the properties, they're going to take the land which is beneath the homes and put that into community land trust. The homes themselves are then going to be sold to the residents at a discount to the market prices. So now the residents who are at risk of displacement are homeowners. Additionally, EPA Can Do is going to be building on those sites accessory dwelling units. You can call them accessory dwelling units, ADUs, granny flat, the in-law that goes into the back. They're then going to have tenants live there. So the people who used to be tenants in these homes and at risk of displacement are going to become homeowners. They're also going to be receiving rental income from the ADUs that are in their backyard. And of course, they're going to be the ones who select who moves into that property. So we're very delighted about that and excited to see the results of this investment. So I hope that this has been helpful for you. And I ask that you remember a couple of things as we continue to invest amidst these chaotic times. I would say first is that we, the foundation, are going to continue to focus upon what we can control to generate top-tier returns and fulfill our fiduciary duties with the $1.5 billion or 1.7 billion that's been donated to us. The second is that we're going to continue to make an impact with our investments. And third, we're going to continue to strive to expand the investment community and its representation, and by extension, the economy to become more diverse and inclusive. So I personally want to thank you for your time today and for your engagement with the foundation. Now we're going to transition here to Q&A. And before we do that, I just would ask if you would grab your phone and snap this QR code. It's going to take you to a survey, and that's going to allow you to let us know if we've been meeting your needs, because we really want to make sure that we're doing everything we can for you as you work with us. And don't worry, if you don't have your phone nearby, we're going to get this sent out to you via email. So I'm going to stop sharing, and then what we're going to do is bring on David and Justina, Sonia and Mike for the Q&A portion of this. And as a reminder, you can use the Q&A function, which is at the bottom of your screen on the Zoom, to drop your question in for all of us to respond to. And you can have it directed to any one of the speakers here, or you can just have it be a general question and I'll pose it to folks. So I want to make sure that we have everybody here. Yep, we do. Good. Okay, so David, I'm going to start with you. You are our investment committee chair. You are also the board's vice chair. I was curious if you could speak to the audience about how you balance the long-term investment goals of the foundation with the current chaotic environment that we find ourselves in, both from all the data that Mike shared out, but also with all the headlines that we wake up to each day and throughout the days.
First of all, thank you for having me, and thank you to the team for all of the work that went in putting this together. I think the answer to your question is actually Mike's presentation, right? I think that that the page, sort of his page that had the checklist of surviving in a chaotic era, is sort of the playbook. The foundation's performance over several decades has been a function of a high level of commitment and conviction to a view that value is compounded over time by investors who are committed to fundamentally sound investment principles. And that conviction is tested not when things are going great, but it's tested when you have times of chaos. And so it's maybe more important than ever that in this environment, we have a sort of a long-term perspective and that we aren't reactive to shocks, and we are looking for investments in either investors who have the same philosophy or investors who share some of the ideas around margin of safety and diversification, et cetera. So I think it's the answer, it sort of sounds trite, but the answer is we need to keep doing what we've been doing. And that means continuing to surround ourselves with great investors who care about the foundation's mission and are able to sort of bring their temperaments, talents, and convictions to the investment committee and helping us make decisions that further the mandate of the foundation.
Great, thanks, David. Justine, I'm going to turn it over to you now for a question. So you sit on the board as well with David, and you're also on our investment committee and on our program-related investments committee, which oversees that Bay Area Community Impact Fund that I was talking about earlier. Could you talk about opportunities where you're seeing great potential for greater alignment between the results we seek in our communities as a foundation, and then on the investment side as well, and where you see that intersectionality?
Yeah, well, echoing David, thank you so much for having me, and to the entire team for putting this event together. It's a really great question, and it really speaks to how we think about maximizing our impact and ensuring that everyone can live in safe and affordable homes, get good jobs, and exercise strong political voice. Foundations have traditionally addressed their missions primarily through grant making, but we know that grant dollars are really scarce and precious, and we recognize that we really have the ability to amplify our impact by using all of the tools in our toolbox and bringing our full financial resources to bear on the challenges that we're looking to address as a foundation. Personally, as a practitioner in the space, I've really seen the universe of impact and mission-aligned investment opportunities grow significantly over the past decade and more. And we're seeing more and more compelling opportunities to invest in funds and initiatives that support things like affordable housing, small business, and local economic development that create high quality jobs and broadly opportunities in the local communities that we serve. And the Vistria and EPA Can Do were really great examples of those kinds of opportunities that we're seeing. But as you noted, Mark, mission aligned investing isn't just about impact. It is also about enhancing long-term financial resilience, which is what is part of our fiduciary responsibility, but also is what enables us to do even more work. And there's increasing academic and practitioner-based evidence that show that impact investments can perform in line with or even outperform traditional investments over the long term. And you heard both Mike and David talk about sort of the way we think long term as a foundation. And we really believe that investing in solutions that address global social and environmental challenges like financial inclusion, job creation, climate change, social justice, really positions our portfolio for that long-term stability and growth that we're looking for, particularly in light of the current dynamic and as regulations, consumer preferences, and market dynamics shift.
Great, thanks, Justina. Mike, I'm going to come over to you now. So questions come in. You mentioned that the foundation needs to hit an 8% performance target in terms of our investment returns. Is that relevant to donor advised funds, or is that referring specifically to the endowment, and what's the difference? So within there, I'd just add also maybe contextualize the targeted investments that we have in terms of return profile for the various pools.
Yeah, absolutely. So yes, I'm using them somewhat interchangeably, although it is very much has to be segmented by each donor's philanthropic time horizon. So for example, if you are going to grant out dollars quite quickly as a percentage of your fund at the foundation, that's not what I'm talking about. Now that should be more in a short-term donor advised pool that the foundation has. And that return profile is much lower. Today it varies with short-term interest rates, frankly. So right now it's in the 4 to 5% range is what we think we'll be earning on that and have been earning on it recently. The 8% though does kind of combine or conflate endowment, where it's clearly the 8% that we need to support a 3% inflation rate plus spending, for example. But then long-term donor advised funds can, it's up to you obviously as a fund holder, but they can have endowment-like purpose, and endowment-like time horizons. And so in that case, it does apply to them just like it would to the endowment.
Okay, Sonia, I'm going to come over to you now with a question that has come in, and that is, let me get to the screen. How did the foundation decide on the social screens that we have in our mission line and pool, as well as those that are being used by the other managers that I had mentioned? Could you provide some perspective about that, please?
Yeah, the screens that were used were in partnership with the leadership of our community impact team. and also being aware of what donors are looking for when they look for a social impact type of pool. And we intended those to be screens that would be maintained over the long term. So we're not doing kind of short-term divestment in or out of this or that. We commit to managers for decades. And so that was what went into the thinking. And wanting to avoid things that harm our communities, and then in the end will end up contributing to our mission.
Mike, I'm going to come back to you with a question which just came in. That is, you mentioned in your presentation that we should seek protection in diversification. As we sit here in 2025, could you expand on this and think about some of the best strategies that you have on your radar?
Yeah, absolutely. So one is the very simple concept of just making sure you don't have have a substantial portion of your capital in any one sector, like technology, for example, or any one country like the US, even though we have a lot, but make sure it's quite diversified across industries, across style of management, i.e. there's nothing wrong with owning growth stocks for my earlier comment, but when your whole portfolio is filled with them, that's when you're taking on a big risk and you're not diversified enough. So it's, invest around the world, invest in bonds, invest in stocks, invest in, and frankly, other currencies, which are, I think, quite, they're the beneficiaries of some of this administration's current policies that we're seeing right now. And then I just want to hammer home something Mark said very, very well before, which is invest in different types of decision makers. The concept of diversity of our decision makers is enormously important, because at the end of the day, I'm trying to simplify a complicated topic, which is, what is a business worth? And the way you assess the value of a business and therefore decide whether it's a good stock to own or a bad stock to own is about what it's worth. And but determining what something's worth isn't looking backwards and saying, oh, this is what it did. It's looking forward and saying, this is what I think it's going to do. And that requires tremendous financial acumen, intellect, creativity, and I don't think I need to tell you on this call. Not only is that not an exclusive trait of white men, it is actually a trait that is greatly expanded upon in terms of providing a diversification by making sure that people who have had very different lives from one another, very different backgrounds, they look at the same set of facts and they come to very different conclusions at times. And frankly, again, you don't need me to tell you, the white guys don't always get it right. And so the fact is that when you have diverse decision makers, it's just spot on better. There's no question about it. And I will tell you one quick thing. People ask us sometimes, oh, now with this administration, are you guys going to change your attitude about diversity in the investment management community? I was like, that's like as dumb a question as asking me whether I'm going to change my attitude about whether I should own one stock or 50. Of course, I'm not going to change. Why would I go away from something that's just better? And so it's a really important part of how you protect yourself today.
Great, thanks. David, I'm going to come over to you with a question that's come in. Could you expand on how the mission-aligned investments pool is different from the long-term pool, and how you as the investment committee think about return expectations for those two, and thinking about this maybe from the lens of a fund holder?
There are two different ways in which the mission-aligned pool differs. I think it's easiest to describe it this way. There's maybe more subtlety in it than this, but without sacrificing returns, so there's nothing concessionary about it. We are proactively doing things that map to the mission of the foundation, and I describe it as maybe two different things. One is the mission of diversifying the investor base, so finding and creating and backing and helping to grow bright young minds who wouldn't have a chance at building a fund, raising a fund, building a business, et cetera. So that's sort of one category. The other category are things that, again, without giving up return, things that are consistent with the pillars of the foundation's activities in the community. So things that are addressing housing, things that are addressing income disparity, things that do that, but that do it through ways that we think still maximize return opportunities. there is a separate pool where it is we are willing to have concessionary returns, but in the mission aligned pool we hold the standards from a return standpoint to the same bar that we hold other investors to.
Justine, I'm going to come over to you. Going off of what David was just speaking to in terms of the mission aligned pool, maybe you could talk a little bit about how the foundation's investments are trying to close the wealth gap that I mentioned in my comments.
Yeah, I mean, I think it's sort of a holistic approach to thinking about how to close the wealth gaps. It's a recognition that there are solutions that can be provided to specific communities to again address things like affordable housing, address job creation, small businesses. So there's sort of that direct impact that can have on populations and communities, as well as some of this how we're thinking about multiple levels of impact. So it's the investment capital itself and where that investment capital is being directed, but also how it's being managed and by whom. And so, you know, I think you, Mark, Mike, and David have now talked about how we think about applying a diversity lens to the work that we're doing, and ensuring that we are supporting emerging managers or emerging investors that may not otherwise have the right networks or relationships in place in order to raise capital. That is also another way in which we are creating wealth and providing opportunity. And it turns out when you hire diverse managers to support your work, they also tend to identify missed opportunities or opportunities that others are not seeing. And that itself also has a lot of impact. So again, and by the way, we think attractive financial returns because it's a less crowded market where there's significantly less competition for capital. So, you know, it is that multi-leveled way in which we're looking for creating impact and closing those wealth gaps.
Excellent. Well, with that, I think we're going to be passing it over to Sonia to wrap things up. And I just want to say thank you to David, Mike, and Justina for the time that you've shared with us today. But Sonia, I'm going to pass it back over to you.
Yeah, thank you all for your participation and for your great questions. And thank you to Justina and David, Mike, Mark, for sharing your expertise and insights. So if we didn't get to your question or you'd like more information, please feel free to reach out to your philanthropic advisor if you're a donor, or to our gift planning team if you're a professional advisor. We'll be sending an email at the end of the week with a recording of this session, along with the same brief survey that Mark mentioned earlier. Your feedback is important to us, so we'd really appreciate if you could take a minute to complete it today or when you get the email. And that survey form also includes space for additional questions or requests for follow-up. And so just thank you all very much for joining us today and for your support of the San Francisco Foundation. We hope to see you again soon.